Thanks so much for joining. Today's session is about working capital. Why are we concerned with working capital and why is it important to understand the working capital position of a company? There are three main reasons. There are many more, but I think three main reasons why we want to understand it better. First, it has implications on valuation. The more money is tied up in a company's operations, the less it is available to pay out for debt holders and shareholders. Second, if a company is in distress, it's a good starting point to understand how we can improve the cash position of a company. And third, the working capital profile and more specifically the cash conversion cycle, which we will cover in a separate session, gives you further insights how efficiently a company produces or manufactures its goods or services. So working capital in general, I mentioned this, is the capital or the money that is tied up in a company's operations. Money that is not available to pay out to debt holders or shareholders. It is used and needed to run your business. In general, I would like to use the term working capital or net working capital. For me, it's interchangeably. The net working capital comes because you use current assets minus current liabilities. So going forward, whenever I say net working capital or working capital, should be used interchangeably, but there are many other terms, total working capital and so on. There will be a nuance which I will discuss in a bit, but for now, net working capital, current assets minus current liabilities. If we go one level deeper, what is current assets and current liabilities? Current assets is usually inventory plus accounts receivables. We did an introduction to balance sheets, so on the left hand side in your assets, inventory and accounts receivables minus, and then mainly accounts payables. There are some other items as well, some deferred tax items here and there. However, I would like to focus on the operational side. That's why I focus on those items. And then discussed earlier, current assets, you may have seen it already. One thing is missing, which is, if we go back, plus cash minus accounts payable. Yeah, so this is net working capital. When we talk about net operating working capital, we would exclude the cash position. We would look at inventory plus accounts receivables minus accounts payable. Reason for me, and when we talk about valuation purposes in particular and talking about and looking at a distressed company, I don't see why the cash under your current assets, it's tied up in your company. It's not tied up somewhere. You can use it. You can pay it out because it sits in your bank account unless you use it as a guarantee or as a warranty for certain things. Then for sure you can argue it is kind of trapped cash. You cannot pay it out. But in general sense, when we do the analysis and later the cash conversion cycle, let's exclude cash because it's not really tied up in your company, in your operations. You actually have it available because it sits already in your bank account. Very important. So how do we think about working capital and in particular net operating working capital? It's quite easy. Your money is tied up. Your money is tied up in your inventory. The more inventory you have, inventory has a value, which means your money sits in your warehouse and you can't use it. So the main goal is try to reduce inventory as much as possible from a financial perspective. For sure, from an operational perspective, you need a certain level of inventory. But from a financial perspective, it's always best to reduce as much as possible. Accounts receivables, from a company perspective, if customers buy your products on credit, meaning they buy the product, you ship the product, but you receive money in 30 days, then your money is tied up in your customer's pockets for 30 days. So you can't use the money because you don't have it yet. You need to wait 30 days in this example. So your money is tied up as well. That's why you see inventory and accounts receivables increase your net operating working capital. More money is tied up either in your inventory or in the pockets of your customers, which you will receive at a later stage. And then accounts payables works in the opposite direction. When you buy raw material from your supplier on credit, meaning you don't pay your supplier in cash, but you pay the supplier later because you have an agreement with them, because you buy bulk raw material, big volumes, and you have an agreement where you may pay your raw material in 60 days, in 30 days. That means you have excess cash available, because usually you would need to pay your supplier today, but because of the agreement, you only need to pay your supplier in 30, or in this example, in 60 days. So you have more cash available now, which improves your working capital position. Yeah, so net operating working capital, inventory plus accounts receivables minus accounts payables. Going back to the earlier example, free cash flow to the firm. I will do another video. EBIT 1 minus T plus depreciation and amortization minus CapEx minus change in net working capital. And here, change in net working capital, if your net working capital is 100 in year 1, and if your net working capital is 200 in year 2, or let's use 150, then you would have minus 50, the difference. And what it means is more money compared to the previous year, more money is tied up in your business. You need more money, you need $50 more to run your business, which means your free cash flow to the firm position is reduced by minus 50. Less cash flow is available to be paid out to debt holders and shareholders because it's tied up in your working capital. Thank you so much. Talk to you later.